Welcome everybody to Fundamentals for Startups, a CoMotion Labs production. My name is Zach Chamberlain. I'm your host today. I'm the Labs Manager for the Life Science Incubator. We are a multi-industry incubator hosting early-stage startups from both inside and outside of the university. We provide our members with critical infrastructure and opportunities for learning, mentoring, and networking. We are always looking to connect with founders in life science, hardware, and tech. And for a limited time, tech entrepreneurs can take Startup Hall for a test drive and see if our resources, advisors, and community are a good fit. Use our QR code and apply today. Fundamentals for Startups is a weekly lecture series related to entrepreneurship. Every week, we bring in new experts to share insights and answer questions. These talks are all streamed on YouTube, and you can learn about upcoming events on our website. Just a reminder, when you're going for questions, please have a mic in hand so our online viewers can hear you. Today, I'm excited to introduce Evan Poncelet, a co-founder and manager of DreamWord Ventures. He'll talk about early stage fundraising and a build to scale. Welcome, Evan.
Hey, thanks for introducing. Good to be here, everybody. Great to see you. A lot of familiar faces. This is great. So a little bit about me and what we're going to be talking about here today. So I've been a software developer in Seattle and the Bay for the last 12 to 15 years. Technical director at African Community Land Trust, which is a great community institution geared around preserving Black community in Seattle's historically Black Central District. Do a lot of work in helping coordinate our startup ecosystem here. And then, as Zach mentioned, managing partner at DreamWord Ventures, emerging fund manager, along with my co-partner, Jesse Posey. And then also executive director of Venture Black, which is the largest professional association for Black venture scale founders, funders, and service providers in the Pacific Northwest from Portland up to Vancouver, BC. So. Talking a little bit kind of at the 20,000-foot view of kind of what we call the innovation ecosystem. Let me see if I got my little red dot pointer here. Really, we're looking at how do we go from being ideas people, entrepreneurs, organizations, coordinating infrastructure, to actually getting the deals done. So in between this, we have a lot of education that we have to do. We have to learn who's doing what work so that we're not constantly reinventing the wheel. We have to be sharing information like we're doing at this talk. And then at some point, people have to kind of really look and see how, all that ideation, all that brainstorming, all that problem solving actually translates to, solid business, sustainable business. And so that happens at this intersection of analysis and review. And so we got to talk about conventions and what you can do to make yourself a more investable startup. And a lot of that comes from just learning conventions. So a lot of that is what we'll talk about today. So first, pulling back and saying, why go through the exercise? Why dedicate ostensibly the next 10 years of your life to working on an entrepreneurial enterprise? Obviously, there's a financial incentive to this. But why do this as opposed to going and applying your institutional know-how to go work at a hyperscaler tech firm, make a nice buck? Well, there's this, which is your purpose, right? And so this is a diagram that I did not invent. It's called Ikigai. It's a Japanese kind of philosophy of aligning your economic output with things that matter to you as a person. And so it's a Venn diagram that's the intersection of what you love, what you're good at, what you can be paid for, and what the world needs. And I think a lot of people find themselves out in the world in some intersection of these quadrants. And what they're really trying to do is get to this middle point, the perfect intersection, where you find the alignment of your passion, your mission, your profession, your vocation. And really, that's what I think entrepreneurship is. So as a founder, it's striving to capture the economic value of pursuing your purpose. And so we'll go into kind of how that can be better served. So a lot of what I specialize in is having the conversation about high growth entrepreneurship. And we'll go into more what that means, but I always find it useful to talk about different classifications of business. Not everything is going to be a venture scale business, and not everything should be a venture scale business. But things that aren't obviously venture scale businesses can become that. But I think it's useful to really find out kind of where your interests are, where your ambitions lie. And so I like to have this talk first. So at the top here, we have kind of three categories of business, and I think that these are not really conventions themselves, but I find these categories are useful, and many people do use them in terms of classifying businesses. So one is really a lifestyle business, or we say a community business, where really your main goal is just to kind of provide a living for yourself. You can think of it as owning your job. Then there's growth scale businesses, and so these are doing a little bit more than just the minimum set of transactions to keep yourself, financially afloat. This is, okay, well, I see an opportunity and I want to capitalize to a pretty good extent. I have like some market share goals involved in this. But then you're not stretching yourself too much, but you're stretching yourself a little bit. But then there's this high growth, maximizing the opportunity, where you see maybe something that hasn't existed before in the world, and you say, you know what, I'm going to be the person that brings that to market. And there's a lot of unknown unknowns there. It's maybe not a business model that has a NAICS code or something like that, but you're going to be the one that pioneers it. And so there's a cross set of vectors that I find useful to consider as we self-identify as one of these sorts of businesses. And so one is just the ambition. So some people, want to put forth more effort or have different priorities than other people or different life obligations. And so that, is something that naturally kind of bucketizes you into one of these categories. The other is kind of growth, which has a little bit to do with ambition, but more to do with what you're willing to do in terms of exerting yourself to meet the demands. So lifestyle, you can open at certain hours, hang up the sign, say, not starting until noon or something like this. Growth, you have to be a little bit more predictable. You're working at a kind of faster scale. You probably have a broader team around you, so you really need to be able to coordinate. And then this high growth, this is, need to meet deadlines. There are potentially significant consequences for not doing so. And really, you're in a foot race against potentially other people that are trying to do the same thing before you and get access to resources ahead of yourself. Then there's the funding aspect. And so a lot of people think, oh, I have the business, and so how will I get funded? And in different categories, there's kind of different available options. And so for community lifestyle, a lot of people will be accessing, home equity lines of credit, personal credit savings, in order to just kind of buy initial inventory, do something like this. In a growth opportunity, this might be something like you have a restaurant and you're going to franchise. And so you're going to perhaps seek like a loan. You maybe have some revenue or some gross receipts or something like that you're going to take a loan out against. And so in this situation, there's kind of a limited amount of outside investment, but it's 50-50 whether or not you're going to get some angels or someone that wants to co-invest with you. But it's really not like this standard venture model. This high growth model, and we'll talk about some of the numbers behind this usually relies on outside funding to meet the rapid expansion that is attributed with this. And really meeting that expansion and to suit the market opportunity that's there is where investors kind of see their fat to be trimmed off. And then there's risk. So at the community lifestyle businesses, there's a lot less risk. Things are more predictable. You're not racing after a larger customer base, a little more let be. Growth, this one you've got different cash flow considerations. You come into crunches, so you have to have a little bit more, we say coordination, so it's something you have to pay more attention to. High growth, everything's moving really fast. It's like a constant swirl of manageable chaos, and so if things go wrong, you could potentially, lose quite a bit. And so something to keep in mind in terms of where you're at mentally in terms of what you want to prepare for as you're looking at how you might run your business. Then there's this little thing called exit strategy. And so this plays into a lot of what investors might be looking for, whether or not they want to get involved in your business with you. And so as a community lifestyle business, a lot of time you're just, your business will last, your lifetime or the span of your interest in it. A growth business, at this point, there's usually someone that's going to come along and acquire your business, or you're going to sell it to maybe another owner-operator or something like this, potentially a private equity firm, something like this once you scale it to certain revenue. High growth, this is usually there's an acquisition path or initial public offering. And really these two, it's similar kind of outcomes. And then just some examples of community lifestyle, your freelance services, blogs, artisanal, cake pops, what have you. Growth, you've got, small business, like I was mentioning, franchises, mid-sized company, your local friendly neighborhood door manufacturer, for example. And then this high growth category, this is your Silicon Valley style tech startup, disruptive companies, and like higher growth ventures. And so high growth, or at least say that phrase, but what does that mean? So the phases of a company, especially in that high growth category, and that's what most of this talk is centered around, you'll see people at the initial phase, and we'll describe more about what that initial phase looked like, getting their business funded through just what they've got in their wallet, credit cards, savings, friends, families, pools, home equity, so forth. Then once they get a little bit more traction in terms of revenue from customers or signups or different things like that, that they can show that there's a potential pathway to a large market opportunity, this is where you start to go out to the investor crowd, or where you might have some collateral that might make loans more appealing. There's also grants, so if you can prove that you can actually execute on something that you're planning, and can write, a good proposal about it, there's different grants are non-dilutive, and we'll talk about what that means. Then once you get through your traction phase, and we'll talk more about different forms of traction, you get into this thing called growth, where now you really need to keep up with the demand for whatever your product or service is. And so this is where the bigger investors really kind of want to come into play, because they'll see an opportunity for themselves in that. And then scaling up, there's things like different debt things you can do that don't require you to give up equity in your company, and we'll talk a little bit more about what that means. But so there's this pathway that we see people take. And so we talk about these different phases, of growth. And when you're building companies, specifically like a more venture-oriented company, there's this kind of idea of like, so what should be de-risked at each funding stage? And then, throwing a lot of words out here, but funding stages, those might not be immediately obvious to people either. So here at the bottom of this, on the x-axis here, we're talking about what stages of funding there are. And so we start with pre-seed, go to seed, and then you have Series A, B, C. There's all kinds of different things. There's like seed extensions, there's A1, A2, A, but this is like the general top level categories of these things. And then there's the valuation of your company. And so this is the enterprise value of your company, which encompasses a lot of different things. It can be the speculative value of your company if it's able to achieve certain goals. It could be what actual blue book value of the assets of your company you have, but the general value of the machine that is your business, your standard operating procedures, your staff. That can be what you consider your valuation. So if you were going to sell your business on Craigslist like it was a car or something like this, what would you sell it for? You can think of that as your valuation, right? So in this pre-seed phase, when you're trying to build your company and you need funding to do it, so you may still be working for an employer or something like this, and you're spending your night like coding up an app or like figuring out some kind of problem or figuring out some kind of solution to a problem. And so this pre-seed phase, what you're looking for funding for is really to address like a technical risk. Like, can I actually execute on a market opportunity? And so depending on the size of the market opportunity, different people want to get engaged investing in you to help you solve that. Because if you get onto something and you're able to achieve this problem solution fit and a little bit of product market fit in this pre-seed stage, and then you'll kind of bubble up to what's called the seed stage. And at this point, you're really saying, okay, well, I'm clearly onto something. I'm seeing, people, a demand for my product or service. And so now what you're working on and the funding that is coming your way is to help you get through this market risk to see, can you reach the market? Will the market grow at a certain rate of that's useful to you? Or is it a more limited opportunity? Is there something that could potentially block you, or some competitive angle that you might not be seeing that one of your competitors might see? So this is really where you're de-risking your go-to-market strategy. And then Series A is kind of more of that. And then also kind of like, okay, how can we drill in? How can we say for like N dollars in will predictably result in Y dollars out in terms of revenue? So that's your Series A round. And so this is typically where you'll find like an actual price per share for your business. Then you've got your total market or your total addressable market expansion. So in your B round, and so this is kind of like a pre-IPO round. This is where your services and products are flying off the shelf at a rate faster than maybe you can fill, and so you're really looking for growth capital. And the growth capital is like, okay, slow down. If I invest this in you, what predictably would my returns be? And so at this point, they really need to be, there's a thing called discounted cash flow analysis. They need to see or be able to realistically project cash flows. And so they want to be able to dial in to the greatest amount possible what the present worth of an investment in your business would be given your cash flows over time. So, and then once you get to that phase, and once you're talking about IPO and stuff like this, now your office is a lot bigger than you might be thinking about. So now you have this idea of culture risk. And I'll get into talk about culture and things like that, but it's like what you're building your company around and the way your company is set up to grow. Is it something that can sustain this trajectory that's going to result in positive outcomes for you and your investors? And so that, is talking about this stages of equity fundraising and at each stage what you should be concerned with. But what does that mean? What does that translate to in terms of like hours or years of your life and, in each of these buckets? And so really this is a vignette of how you'll be spending your time and different kind of conversations we'll have. And so typically in this pre-seed round, you're looking at spending about a year somewhere, and I don't think I have it in this presentation. There's a great graph of the time to MVP to first customer that really goes through and shows you where famous companies like Canva or Figma or any of these sorts of Notion would be another one, what it took them in terms of time. But for this will help roughly how much time people are spending in each of these different phases. And this varies quite a bit. These dots are not like, there's a big kind of range bar that would be here, an arrow on these. So generally you're spending about a year, 18 months in your pre-seed. Similarly, past year plus for your seed stage. And this is like here we were talking about like getting to market. And so, so if you're year 3 into your company, this is, if you're really working on this high growth path, these are kind of some benchmarks for you to think about. You're going out for a price round, so this takes a little bit longer. So you can get up to 2 years, 18 months on something like this. It can be longer. Like I said, these are just kind of benchmarks. So you can see kind of the trajectory of how you're spending your life. Now, year 5, year 6, so this is, a pretty decent life commitment, right, to your business at this point, right? That's your Series B, and there's dollar amounts associated with this as well, and valuations associated with these, and we'll go into those. But generally, like this is kind of as you're building your company, as you're trying to go through each of these kind of toll gates, right? The general times associated with them, just so you can, as a scoreboard or a time benchmark for your entrepreneurial journey. So that being said, so we talked about stages of fundraising, and so here I find it useful to talk about kind of where people are doing this. Where is this happening, and what are their outcomes in different regions, right? So this data is from July of 2023 to June of 2024. So last year's data really. And so this is talking about digital startups in certain metro areas and physical startups. And so these are your hardware companies, your biotech companies, and digital startups, SaaS, fintech, edtech. These are general categories of more scalable businesses that meet that high growth consideration. And so we can see, Seattle, we had a little bit of a dip, I think, in 2023 where we dropped down to like the 20th startup ecosystem for different reasons. But, we're back to 5 in 2024 here. And so we see that let's see here, I think this is early stage funding. But we see, the Bay Area obviously is very dominant in these deals, right? So we see a lot of people in our ecosystem going down to the Bay Area to raise an early stage, or after they've raised to go down there to take advantage of that ecosystem. Similar New York, similar Los Angeles, similar Boston, but we're holding our own here. We are the number 2 AI hub, and in terms of tech talent density, our region of the Northwest is the most dense in the country, including like the Vancouver metro ecosystem. Physical startups were a little bit lower. Our CPG sector and kind of a lot of our hardware stuff is actually located further south. So like Clark County, Vancouver, Washington, and then Portland's ecosystem has a lot more kind of physical startup activity there. So if you're going to find investors, right, important thing to say is, and I kind of like this analogy, what's the value of a can of Coke, right? So maybe you've seen this like on your Instagrams, right? So it's like when you're trying to buy it from the store, a can of Coke might set you back maybe 50 cents or something like this. If you're at a theme park, you're gonna pay about $2 for that, right? If you're at the movies, for that same Coke, you might spend $7 or something. So, the value of your business will be different on the ecosystem's ability to appreciate your business. If they're not familiar with your business, they're gonna not be able to appropriately assess your business. And so don't just take for a given, what people want to value your business at. And just keep in mind that it will vary on where you go and whether that ecosystem has more competency in your specific kind of business category. So just something to keep in mind as we have this early stage talk, because a lot of people just go out there, try to find any investor that will talk to them. The investor says, here's what I think your valuation is, bada boom, and you have some problems with that, right? So shop around. Remember that shopping around is a geographic process. And so here we have top cities with the earlier stage rounds, right? And so here we have total rounds under $1 million, and this is data, again, from 2023 to 2024. And these are for safe notes, which are simple agreement for future equity, which is a common legal deal apparatus to gain cash for your business in exchange for future equity after a conversion event for your business. And so here we see kind of like some strict dollar totals and similar percentages. So in this early stage, the Bay is really doing a lot of work here with 24% of the funding coming back to us. Here at 9 in this, and so $14 million for the early stage safe notes. And so we'll see what that is in terms of for the given amounts raised in different business categories, what $14 million really translates to. And then let's see now, this is another kind of comparison for metro area startups kind of in the early stage. So I think I just have two cross-reference. But you see, Seattle, we're doing pretty good work here. And so here I want to have the conversation about enterprise value. So I was saying, as your company is growing, it has some valuation attached with it. And so here we see at the top here, or this y-axis, is the number of companies that start every year. And then the lifespan of companies. Here we see the number of companies dying, the attrition rate of companies. And then this line here is the growth of enterprise value of companies over time. So we see that they say lemon trees blossom early. So about 38% of startups will fail within their first 3 years. And so this is common. This is why for investors, this is considered a very risky asset class. But we see that these companies that survive, this 3-year kind of value of death mark, tend to then start acquiring enterprise value through gaining employees, having more standard operating procedures. They, have gone and found customers. They're learning what works, and so we're starting to see this up and to the right thing. And this is where a lot of startups that I find as an investor are really starting to gain their enterprise value. At this point, like a lot of people that are crossing this chasm here, they have consulting hours that they're selling at some rate that are keeping them sustained while they're building kind of their core product and offering and things like that. But as they really start to reach the market with their core offering, as they start to find their customer and be able to talk to their customer better, that's where we really see this growth. And so to think about when you're building a business, it can be a free-for-all. There's a guy that has a great way of saying it. There's bidness, there's biz with a B-I-Z-ness, and then there's business, right? So bidness is just this idea of it's like anything goes, right? I'm just selling something, hit me on your Cash App, I got this greasy rag to sell you, what will you pay for it, right? Then there's business with the Z, which is, okay, my cousin Tony will come around and do my books and accounting, every third, Friday or whatnot, right? And so these very loose, business sorts of things. But when you start to dial it in and where the vehicle of your business actually starts to have market value is when it's business, where you have standard procedures, where your different functions aren't dependent on specific personalities filling them and things like that. And so that's where, your business starts to really have value to investors. And so we'll talk about that more. But in order to talk about that, we really have to talk about kind of more of the funding conversation. So what are some sources of funding for your business? How can you fund the investment in your company that's required to be able to have enough, to pay for human labor to do your books on a regular basis, or to be able to service those standard operating procedures or originate those standing operating procedures around your products and services. So one is to talk about a non-dilutive source of funding. And so non-dilutive means that that in exchange for the funding, you're not giving up some share of your business. So grants and subsidies, this is a way that you can acquire cash or capital for your business without necessarily having to sell a portion of it or take out loans. And so loans, right? So debt, taking out a note obligation where you're going to be paying back on some schedule. So there are fixed percentage rate loans, but there are also things like revenue-based financing or financing based off of other kind of calculation mechanisms if you have revenue or receipts or different things like that. So debt can take a few different forms. It's not always just fixed. There's gifts. So if you go onto certain like crowdfunding sites or certain things like that, you can, like GoFundMe would be an example of this, right? You're just getting the cash. There's certain kind of tax things to do with that, but so that's another way you might get some cash for your business where there's no obligation to pay. Equity, and so this is really where we're talking about the fundraising rounds and things like this. This is you're giving up some percentage of your business in exchange for the capital to grow your business. And convertible instruments, this is similar to equity, but there's a thing with these convertible instruments where it's not equity just yet. So it's the promise of future equity in case something happens. So a couple standard arrangements to this. So there's convertible notes, which are a loan against some percentage of money that people give you, but at some conversion event. So like if you, it could be like a temporal thing, like in 2 years, then this note becomes due and you either pay or it converts to equity. Or there's the simple agreement for future equity, which is, okay, I don't owe you anything today, but upon a conversion event, when I go and raise a priced round for my business, at that point now, we're issuing shares, and we've agreed, what the value of those shares are going to be in this simple agreement for future equity. So it's not equity yet, but in the future it will be according to some standard terms and agreement. And so to talk more about kind of that equity round, so like here we're using the Shark Tank model. So whenever you watch an episode of Shark Tank, here is something along these lines. I'm seeking X for some Y percentage of my business. And so doing the calculation on that, so if I'm seeking, like $500,000 for 5% of my business, we say, okay, well, how much of my business is that, right? So 5/100ths, right? So this is 20 units. We take, 500,000 times 20. We see that, okay, well, the value of your business then is $10,000 or $10 million, sorry. And so that's the post money after the investment valuation of the company. So 5% of the company, or $500,000, is 5% of $10 million. So that's how these valuations are being estimated, and that's how it arrives from how much of your business you're selling for what amount. So outside investment in U.S. startups, so here we have 500,000 U.S. startups annually. These numbers are, I think, from a little bit of time ago. So what percentage of those companies get venture capital? What percentage get angel investment? What percentage are getting other forms of outside capital or no investment? So we see that the amount of companies that actually get VC investment are actually pretty small, but that doesn't say anything about the dollar amount of these companies receiving that, but the number of companies that get VC investment is 6%. And I think this number is from like 2017, so it is a little bit of time ago, and these numbers dance a little bit back and forth at this margin here. Companies that get angel investment, 30% of companies, so angel investors do actually a fair amount of a lift in the investing ecosystem. But what's interesting is that the dollar amount, the volume of dollars, is roughly equal between angels and venture capitalists. So you're seeing a lot more smaller transactions from the angel investors, fewer but larger transactions from the venture capitalists. And so here, hopefully we can see this. I'm not going to be so brave to mess with the IT to go to my separate link where this is in a much bigger form, so I'm going to hope that you can see this, and I'll navigate around with my laser pointer here. So here we're looking at the startup funding, and here we've got some nice graphics that can put you more in the founder space, right? So here we can all relate to being in the idea stage where it's you, your laptop, and a bunch of tabs in your browser where you're like, hey, wait a minute now, I could solve this problem, I have the know-how, or you're like, well, I don't have the know-how, but I'm aware of this problem, and I know somebody that has the know-how to design some solution that can scale to suit this problem. So in the idea stage, you might invest, $1,800 for your cloud credits or for whatever, various things that you'll need to get started. Maybe that's your investment in your laptop or some initial like hardware workbench solutions, your signal analyzer, what have you, right, to start on your solution. Co-founder stage, now you've got to have the talk, right? So how much of my business am I giving up because I can't pay this other person to help me work on this business? So at this stage, this is assuming an equal split, right? Now you've split the equity of your company, and he's giving you your labor, or she's giving you their labor in exchange for some percentage of equity in your business. Now you've got your friends and family around, and so in this case, you're like, okay, well, we need some additional equipment, or some, service consumption in order to grow our business and actually get our customers in the door. And so at this stage, now our business is actually going to be worth something because our I believe, Pink, it could go chartreuse, uncle is now going to invest $18,000 in the business. And so he's going to, in exchange, we saw that Shark Tank slide, right? In exchange for 5% of your business in this early stage, he's going to give you $18,000. And so, so he's going to give you $18,000. And so your company now has some like basic valuation. This is a little premature, but he's also stipulated that you do an employee stock options pool. Advice is to delay making the stock options pool until someone makes you do it. But your uncle's savvy, so he's going to make you do it. So now you've split up the equity of your company. So you see your uncle's got 5%, this to-be hired staff has potentially 20%, and then you and your co-founder have 37% and some change. Now, you've grown through these britches and you need to bring in some more capital to do some more work. So you need, I think that says $200,000 to do something, buy some inventory, office space, do some market outreach, something like this, right? So now you actually need some cash, hire some more development staff for your business. And so now you're going to go talk to angel investors. So these angel investors now are going to invest $200,000 in your business. And you said, okay, well, what I think we've got going on here, we believe, the value for our company is $1 million based off of maybe the revenue that we've got, maybe what we think the market size is. If we're able to reach that market effectively, this should be our valuation, right? So, and we'll talk a little bit more about how these sorts of things are calculated. So now these angel investors have bought some share of your company, and you see you're being diluted down as more investment comes into your company. And so the idea here is that 100% of nothing is a lot less than 17% of a big company. So as you see you're being diluted, but you see that your company's valuation is going up. So if you have 100% of a company that's only worth $0, that's obviously nothing. But if you have now 31% of a company that's now worth $1 million, that's something to be said. Going further with that analogy, now you're bringing in a venture capitalist here. Venture capitalist, you're saying, my company's worth $4 million. Can you give me $2 million? So they're buying some share. You're further diluted, and we'll talk about what's healthy dilution, what's not healthy dilution. And so it goes, right? And then you get up to your IPO, and so this is happening after perhaps your Series C round. We talked about rounds earlier. More venture capital interest coming in here. And now you've got 17, you and your co-founder are diluted down to 17.6% of a $2.6 billion company, which is a pretty good eating for having spent that 10 years of your life building this company. So that's fundraising and equity stuff. And so, but we have to go back to the talk about high growth, right? So this is a set of benchmarks compiled by the Founders Institute. And so we'll look at what the growth metrics are for each of these earlier stages of fundraising. So for pre-seed, seed, and Series A, what you're looking for is traction in terms of customer validation in your pre-seed. So customer discovery, saying we can actually use the solution that you're offering us for our problem. And often, so there's a growth rate that's associated with this between 0 and 20. The closer or the higher growth rate you have is better from an investor perspective, also this monthly revenue. In this stage, really what you're trying to do is prove to yourself that you are meeting a significant customer problem with a valuable solution to them. And so Dave Parker has a good way of describing this, which is that you're selling them aspirin, something that is attacking a very immediate and shrill pain, as opposed to a vitamin, which is something where it's like, maybe that's okay. Maybe I need it, maybe I don't, right? So you can prove to yourself by the rate of customer acquisition, by their willingness to pay, these sorts of things. At this phase of your business, it might just be you and your buddy and a laptop. Your product is a minimum viable product, and so some best advice on this is, get something out the door, let the market tell you what it needs to be, and as the market informs you, you'll find that you're getting more traction. The different investor at this stage, friends and family, seeds and accelerators, so this is where you'll go to your Antler, your Techstars, depending on what ecosystem you're in, or what have you. Your friendly neighborhood angel investors, pre-seed, micro VC funds, so forth. Typically in this range, you're raising 25K up to, really this gets pretty high. I got a different graph that covers this a little bit better. This data might be dated. Company value between 1 mil and 5 million, and we'll talk about valuation and how that can be calculated. Investment vehicles that are common, safe, or convertible notes. Different angel investor groups prefer different notes. Safes are more popular these days. So now, okay, you've gone through your pre-seed, you've tested, you've got your de-risked, your problem solution fit. Now you've got this product market fit. Like, how are we stimulating demand of the customers, or what's the demand look like in that situation? So here you're looking at a growth rate of 15 to 30% month over month. It doesn't have to be this necessarily. It could be higher too, depending on what your strategies are. Monthly revenue, so these are some comfortable numbers, right? So you can just see, like, at each of these stages, these are, rough ballparks of things that you're looking at in terms of saying what your valuation of your company is, right? Which can sometimes be estimated as a revenue multiple. That's kind of a safe benchmark for a lot of investors. What your team size roughly looks like, so you can think of, when you're out here in CoMotion, if you've got a space here, like how much of your team, you'll be having in a space like that. Your product is looking a lot more polished now, and it's something that, that your customers are, obviously they're gonna have demands and things like that, but it's less buggy, and you're focusing more on kind of like the business logic of it and developing out, features and things like that. Common wisdom here is, like, if you don't feel a little bit embarrassed about releasing your product to market, then you probably waited too long to do that. So just something to keep in mind there. Investors here, so seed stage accelerators, angels, seed VC, usual suspects there. Round size, again, these numbers are very conservative, but I'd say really in seed stage, like 2 million, 4 million, and depending on what kind of business you have, there's a chart that'll explain it, so I won't go too deep into that. Company valuation, similar concern there, but 5 million to 12 million, we'll go with that for now. Investment vehicle price round. So at this stage, someone is saying, okay, what's the actual value of shares in your company? So when that decision gets made, then that actually causes prior things like safes or convertible notes to hit their conversion event, which then says, okay, now there's actual equity there. It's not like the promise of future equity. Now these shares have a concrete price, and that has certain considerations for that. So then you have your Series A here, and so this is your expansion phase. And typically, actually, this is really when you'll see a priced round. I don't see too many seed rounds these days with the price rounds. So Series A, this is expansion, so scaling up. They said the go-to-market, de-risking, 25% month over month. Again, these numbers, depending on your industry. Monthly revenue, 200K plus, team size. So this is where you'll see, like, someone will hang their shingle. They'll have a big sign. They'll be taking up some floors of, I don't know, Columbia Tower or something like that, right, to expand their business out. Their product is fully commercial already at this point, because you're really trying to hit, okay, what's the maximum customer acquisition I can do for the lowest cost, and really dialing in those numbers. And so the folks that will invest in this, Series A, growth VC funds, existing investors, and really, nowadays, really, like most VCs that you'll see, especially in Seattle's ecosystem, are Series A investors, which is like, the early stage stuff is a little harder to find. And so you'll find more angels that are invested in that space. And then what I've noticed is a trend of actually VCs from other ecosystems coming to our ecosystem to invest in early stage. We see round size, these are loose numbers, and we'll have better charts for that in the future. And then investment vehicles priced round. So here's that chart that I was promising here, which on the bottom here is the x-axis here is median amount raised by the company, and on the y-axis here is median valuation cap of the company. So we see that these are for different sectors, types of businesses that you might have. And so for different types of businesses, it comes into a bunch of different investment considerations. So certain businesses that might have more tangible goods that are associated with the enterprise value of their company, these people will commonly take convertible notes for, because there's asset kind of backing that. Ones that are less tangible goods will usually have more safe fundraising. So, but for like SaaS is kind of a perennial favorite, as you see kind of like the diameter of each of these circles is kind of the volume of these sorts of deals that get done. You see biotech up here has like a higher raise because like they're more capital intensive, but they also go for higher valuation because they're high acquisition targets and then high cost, and health, like if they are able to hit an industry, their total addressable market is usually a lot of people. And yeah, so you see, for your different types of businesses, you'll be raising different amounts. And so this, again, is the pre-seed stage fundraising. For each round of fundraising, you'll see that the valuation caps go up, that the amounts raised go up. But, hitting the dead middle here, we'll say that, so the median amount raised for a SaaS company, this says, like in pre-seed, this says 800K to 1 mil. I'd say this has actually shifted a bit up, so this is maybe older data. So this I'm seeing more like the 1.5 mil for SaaS in pre-seed, and then this valuation 12 million, so 12 to 18 million. That's a reasonable valuation for a lot of these pre-seed SaaS companies that I see out here. So, but you'll see people raising all different amounts. The main thing is like I was saying about knowing the value of your company, and we'll talk about like how to arrive at those kind of conclusions. But keep in mind that you should do some research about your company, look at what similar companies to yours might be going for in terms of valuation or what they've raised at. And there are many different ways of doing it that you guys are probably all aware of, so I won't go into that too much, except to say, Crunchbase, PitchBook, or use some of your university resources to do some of that research. So giving you a little bit of the investor perspective. So when someone's looking at investing in your company, what are some of the forces that are acting upon them that are governing some of the calculations in terms of whether they will or won't invest in your company? So we talked about this a little bit earlier. So 56% of companies are failing. We're seeing that in early stages, right? So we see that 35% return 0x within the first 3 years. This is the lemon trees blossom early kind of thing. We're seeing 35%. This is for any given portfolio. About 35% of a portfolio or like marginal, like 1x increases or so. And so this is these companies that are surviving past that 3-year, death valley. And so if they return in this time phase, they're typically returning 1 to 5x multiples, different things like that. So, okay, good for you. You got some return as an investor, but it's really, did I beat the S&P 500 in terms of investing? Was it really worth that calculation? Maybe at 1 to 5x, right, in 3.3 years. I mean, that's a pretty, short turnaround for, nice return multiple here. But then you see your 9% and that will stay on to be 10x investments. But, when do those return, right? So here we have a good time moniker for that. So we see that, so here we have the return multiple on this axis here. Above each of these bars is the years of return. So here we see the percentage of total exits. So we see the big kind of out of the park things that 10 to 30x or things like this. They take longer to return. There are fewer of them, so the likelihood of you getting these is much smaller. But the calculation that investors are making in their head, if they're investing in a venture scale business, are typically that, okay, this business has a very high likelihood of being absolutely nothing, big nothing burger, but profound if true, right? If this thing is what it says, if they actually can reach the market, if all of this risk, is mitigated and they're able to actually reach their total addressable market or some fraction of it, sort of obtainable market, then it's going to be a big deal. So 1 or 2 of those companies out of a portfolio of about 20 companies is going to hit that, and they have to be selecting companies for that portfolio such that any of those companies could be the one that justifies all of the other ones being a loss. So if you're going out there and trying to raise funds and you're not a company that can scale to $1 billion valuation, for a lot of investors, that's not to say all investors, for a lot of investors, they're unicorn hunters, which is a common way that investors consider themselves. They're not going to be looking for you. So you either have to tell them a story that implies that you're going to be able to scale to that, and you should, in good faith, be telling that story and have every intention of building your business to be able to scale to that. Otherwise, you're going to have some very upset friends. But that's what they're looking for. So if you have people telling you, I don't see the market opportunity there, it's because inside of their head, they haven't justified you as being one of these high return potential companies. And for this very risky asset class, they're compiling this portfolio such that they can have this high, we say, annualized percentage return on investment, this IRR, which is internal rate of return, of really between like 20 to 27%, and that's VCs versus angels. So VCs are looking for like a lower rate of return, but they're looking for less risky businesses. Angels are investing a lot earlier. Pre-seed stage funds are investing a lot earlier. So they're looking for a higher IRR for taking more risk on. And average holding period of 3.5 years, maybe not so much. I mean, considering the people exiting early because their companies have failed, yeah, maybe that justifies it. But like people that are investing are really looking for returns between like the 5 to 8 year mark, but with the understanding in their head that it could be 10 plus years. And so they're investing with all those things in consideration. So that goes back to this conversation about kind of enterprise value. So when we're talking about, these return timeframes, this 3-year return, like I was saying, so this is, okay, now we're finding like the wheat from the chaff, right? When we come to, going to the 5 years and so forth, now we're seeing the enterprise value grow, right? And so this is basically equity growing in a business, which means markups or unrealized gains for an investor. Okay, so we talked about valuation, which was on the y-axis of, let's go back to it, this graph here, right? So how are people coming to these conclusions that my company is worth this much and that I should be raising this much, right? So obviously, how much you should raise is depending on what you would need to accomplish milestones to grow the enterprise value of your company or the equity of your company. But okay, how do we know how much this is actually worth to anybody and how much they should pay for some fraction of the business, right? So there's different methods, and so here we'll go over one, and so I love kind of this I don't find to be exactly true, but I just thought it was funny that he said it. So Toby Stewart, who's I think chair of entrepreneurship at Berkeley School of Business, says there's discounted cash flow analysis, and then there's bullshit. And so this is, he's a very swearful guy, but what a discounted cash flow analysis is basically saying, okay, for each year of your business, what are the expected cash flows, right? And there's some terminal value that says, there's some ultimate cash flow, let's say 10 years outside your business, which will be the time point at which the company will have IPO'd or been acquired or something like that, right? So applying a discounted rate, accounting for the fact that your business is likely to fail, right? So this typically is about 20% or something like that. Calculate the present value of those cash flows to determine how much I should be paying for some percentage of your business. So that's discounted cash flow analysis. And so this typically is really only accessible to venture capitalists. They're investing in companies that are post-revenue, that have already gone out there and met market to some extent and can predictably forecast revenues. So, but that being said, there's a lot of fluff there. There's a lot of estimation. So accounting for the fluff, what people have gone and done, especially kind of in the angel categories, is this thing that's called the scorecard method. And so, actually, let me just make sure that this is that. No, actually, so what we're looking at here is the Berkus method. And so this is the most rudimentary way of quickly doing some napkin math from the valuation of a startup. And so what it does is it assigns like a point value. So between +2 and -2, and gives to that some amount of dollars, so $500,000. And these change depending on what sector you're in, right? So, but what you could do to do a Berkus method analysis of the valuation of your business is go, I'll make these slides available to everybody in this talk, go back to that chart, figure out what current valuations are in your sector, right? And then modify these numbers such that you at the high end of whatever the sphere was, right, for the valuation, the high end across 5 categories sums to whatever amount was on the high end for that valuation, and like adjust what this highest score per factor is, right? So that's how you could use this method to value your business. But let's go into what these factors are, right? So one is it an exciting market opportunity? I don't know if you guys have already gone over like TAM, SAM, SOM, these sorts of things, but it's like, is it a big enough market that if this person made any dent in it, that it would be worth anything? So if I'm selling like firecrackers to ice climbers or something like that, how many ice climbers are buying firecrackers, right? Is that an interesting market? Probably not many, maybe not such an interesting market. Or maybe there's some new firecracker like law that's going into effect somewhere that will now create this monster market for firecrackers amongst ice climbers, right? So is it an exciting market opportunity? Can someone reasonably convince me of that? Can this team of people in front of me just now actually get this company to break even? Like, are they the people that can, de-risk this company and actually get something together? Risk of execution. Is there a prototype? Is there anything? Is this vaporware? Can the person that's talking to me, do they have any technological means of developing a solution? Market acceptance. Has anybody said that they're willing to buy this thing? Will a supplier maybe give preferential terms in order to get involved or in order to consume some contractual quantity of this good or service? Is there any revenue there? Has anybody paid for anything? And this is for the core product that they're trying to sell. So a lot of investors, they'll go out there and they'll see someone that's selling consulting services, and yeah, that's keeping their business afloat, but it isn't really testing for product market fit of the thing that they've built their business around, like the thing that they really are assigning value to. So is it actually, are they making money off of the product or service that their business, what do we say here, value proposition of their business is centered around? So for each of these different factors, go through and give yourself a +2 or -2 based off of your, what you feel your strength or weakness is in that area. And for each of those +2s or -2s, you can add this amount of value to your company. And so the summation across each of these different vectors amounts to what your initial valuation cap of your company would be. So that's one way of doing that a lot of angel investors use. And so here's that chart again, just to draw on the point that you'll use this top line metric and then divide through this top scoring factor in order to do that calculation. So going deeper into those factors, right? What are investors looking at in your startup to consider you investable? And so I'll talk from like the early stage investor's perspective. That's where most of my familiarity is, but going into what we're saying about discounted cash flow analysis and like as close as possible to the estimation of the value of your company, there's a lot of similarity between early stage investors, late stage investors, and so different investors have different ideas about what makes a company investable. They're cousins, usually, these ideas, but they're not distant relations. But people will put different weight on each of these categories, and that goes into the next method of evaluation, so we'll have this talk right now. So typically, what the first and most consideration is your market size. So is there a large enough total addressable market? Is there enough people that could potentially be worth paying you for the solution to even spend 10 years of your life, any amount of investment in pursuing, right? So that's typically the top line consideration. Because if there's much to do about nothing, why bother, right? The next thing that typically people are looking at is the team. So should I say this is the right way of thinking? Yes, so the team, right? So I'll say the team, and then something that I'm not saying here that is here really is, we'll say the idea, right? So the idea and the team, right? So we'll put those two together for now. So a good team that has a bad idea will typically still succeed. They'll find a better idea, right? So if I'm an early stage investor and this team, they're domain experts or something like that, if they found one thing that they think is a problem for the market, they're going to go do some customer discovery. They might disprove that thesis, but they have enough domain expertise, enough technical skill, enough know-how to pivot, right? So I would invest in that team maybe regardless of where their initial entry point is into a thing, just to have that ticket, right? Have these people previously founded startups? How did they do? Did they exit successfully? Past performance is oftentimes a great predictor for future performance. So that's like the next consideration that people have. But then the other idea, the thing that plays in that, which is the idea, is okay. What's the actual idea, right? So if it's a bad team with a great idea, how good is the idea? How big is the market? Maybe can I convince these people to take on different people? So we'll do mental calculations around that. Then the next deal is their defensibility. So it's like if you have a great idea, a great team, the market's there, right? But you have no way of preventing someone from immediately coming in behind you and doing the exact same thing you're thinking of. That's too much noise for me. I don't know, which horse to bet on in this. There's no clear winner, right? Why would I do that versus another deal? And so the next bit really is, and I think when I say idea, this is proposition here, so that was what I meant to calculate in that. Then the next bit is traction. Usually people are like, okay, well, you got a great idea, great team, or so-so team or whatever. There's clearly a market for it. Okay, well, what's your execution actually been like in terms of finding customers? And so do you have an MVP I could look at? Has anybody been raving about it? Is anybody actually paying you money for this thing? So, this traction. And so I'll say, as capital becomes more scarce or people become more risk averse, they're looking for more proof of traction to justify their investment, to see that you're further along. And what you can always do to get better terms of investment and to give up less of your company for higher dollar amounts is have proof of traction. To be in a position where you've got the best alternative to negotiation, which is, I could take this deal or leave it. Honestly, my revenue will be fine, so I'm going to wait until you come up with better investor terms or want to, give me a higher valuation that justifies, where I've gone in my company. So this traction is always going to work out for you. And the best way to go about getting this traction is to actually know your customer and what they want. So do effective customer discovery. So these are, calculations, financial forecasting. This is, in the early stages, a lot of that's loosey-goosey. You really kind of got to get more dialed into cash flows and stuff like that for that to become a consideration. But these are generally the ways that investors look at your company. So we've talked about discounted cash flow analysis. We've talked about the Berkus method of evaluation. Now we'll talk about kind of the middle in-between valuation thing that I think has the most value. And we're all familiar with this in some way, shape, or form because, we're calculating grade point averages, things like this. So this is the way you can think about that, is weighted averages or a weighted scoring of your company. So similar, right, we see evaluation parameters. We're assigning different weights to them, right? So strength of the management team, you give that 30% weight, size of opportunity, 25% weight, technical product, 15, competitive environment, 10, market sales, 10, and so this is special sauce for different investors. Different investors will have different ideas and for different sectors, which are the most important based off of their experience. The parameters of the actual weight, and so this is, what's decided. So these are ranges of weights. This is the actual. Your target, so if I will, as an investor, only invest in companies that maybe, reach some, number of hitting this goal, and the factor strength. So multiplying your factor strength by the top line valuation on this graph gives you what your valuation would be. So if the top line valuation for something that had a $3 million valuation all the way down here, well, that's not much. So that's, kind of old valuation. But let's say you're a food business down here that's raising on a $3 million valuation. Your best opportunity is $6 million. So we'll just replace that number with $6 million. So or I guess they went for average, but we'll go for the top, right? So if you want to be conservative, you can go for average. So let's just say what we're doing for the 300,000 here. So this is like a proxy, right, of valuation that you could put for your company based off the sector that you're in or other, valuation that you've seen for other companies, given what you think about your company, or maybe what some of your peers have said about your company, right? Or maybe you shop this around with investors or something like this, right? So they're going to come up with this valuation for your company. And so this is your, pre-money valuation before anybody puts anything into your cup, right? What's the thing worth? And so that's a weighted scoring. So this is the way people see that as well. So exercise for the reader. Okay, perfect. And we're coming to a close here. So we've talked about these different phases. We've gone on this journey of bootstrapping, right? What that entails. So we have our, grants, family, friends, fools. We've got our traction, right? So we were talking about, letters of interest, people wanting to actually buy your product, people having bought your product, raving customers, people giving you advantageous supplier terms, different things like this. The capital to grow your business, going to VC, going to angels, and then as you get higher, now you're taking on debt and things like that that don't require you to give up a percentage of your company. Now we should talk about, okay, well, I'm going to give up amounts of my company. How much should I give up of my company, right? So this is a way of looking at what you shouldn't give up in each round. So here we have at each round what's worth your time to. If you give up a certain amount of your company, it's no longer really worth your time to be working in that company compared to other ways you could be spending your time to earn money. So you have to be incentivized by the amount of equity you retain in ownership of your company after giving away equity of your company to investors. So a broken cap table is like, okay, so at the idea phase, I own 100% of my company. That's the best possible option. You've given nothing to anything. You're strongly incentivized to work in your company. If you've given up 90% in the idea phase, well, okay, that's a little interesting, right? You just have an idea here. You haven't executed anything, and you've given up so much of your company. When you give up, what is this going to be, 30% of your company, now you're in this red zone where it's just like, why did they give up so much of their company so early? And then, so now they're going to have to give up more of their company in order to grow. So at the end, how much will they actually retain? So if by their Series B, they only have 10% of their company, well, if you cash that out and they, get exited and acquired for like 50 million or something, and they're only in 10%, well, they could have just gone and worked for a hyperscaler tech firm and gotten 400,000 a year or whatever, worked their way up to the project manager track. So why did they work 80-hour weeks for, the last 7 years to do, so it's like, doesn't make sense. So giving up only, like we say, I think it's like 30% by the end of your seed stage, that's a sane thing to do. But once you start giving up more of your company here, then that starts signaling to investors, this person doesn't know the value of their time, doesn't know the value of their company, and there's not enough meat on the bone for additional investors down the track. So I'm not going to give my money. It's not worth anybody's time. And this is where we see companies die on the vine a lot of the time. And people generally don't know this. So when I give these slides out, just remember, look at this table. Let's see here. These are different equity grants for different companies. So the idea of giving away equity or the idea of giving away equity to someone that's no longer adding value to your company. This is called debt equity. This is a scenario to avoid. There's this idea of too many investors in your cap table. So every uncle, friend, whatever, now has a single line on your cap table for like the $5,000 that you gave to a VC that is going to come along later on in the process now has to buy all that, and so it's like a whole headache to work on. So, too many, investors in the cap table make your company less attractive investors. Founders with less than 80% before seed round. So if you've given up too much of your company, that's not really interesting. An investor with too much control. So now are you running your company or is that investor running your company? And then there's the idea of how much you give at each round. So this is another card that has a good pool of data on here. And so you can see averages and things like that. So these slides will be available for that. These are just like general considerations around how much to give to your first employees, to your executive employees. And this is at each stage. So like your equity is worth the most at the earliest stage. So, and less as you go up. So if you're already de-risked your business and now you're bringing on a C-level exec, you're going to give them less percentage of your company because he's taking on less risk. In the early stages, you might give someone more because they're giving you more of their time and for a more risky endeavor. And here's some different founders' equity at the end of the game when they've had an exit event or a liquidation event. And different SaaS founder equity at IPO. So you can see, if you give up too much of your company, which is, poor Cortler and Zena at the bottom here with DocuSign, but it's like, so make sure as you're going through and giving away equity in your company that you don't end up to the lower end of this spectrum and that you get to the highest. And so this is my last slide, which is just where are these deals being done in the country. We touched on this a little bit with the other average charts, but we see in this great Pacific Northwest of ours, we've got 10% of the pie. The Bay, our cousin right next to us, doing a great amount. What is this going to be called? The Midwest and South, doing a suspicious amount of deal activity, right? Great, right? And then the Northeast doing a good amount of work as well. And then there's Toronto up here is doing a lot of great deals, and Vancouver up here is doing a lot of great deals. So that concludes the presentation. That was a lot of information, fire hosed it. But do I have time for questions?
I think we have time for about 3 questions.
Okay.
The first one came from one of our online viewers, which said, At what point can you expect to pay yourselves as founders at the pre-seed stage? Is there a bare minimum?
Is there a bare minimum? So it really depends on what your needs are, right? So different investors will have different ideas about whether or not you should be paying yourself, but it's like, what do you need to maintain your lifestyle? And like, what are you willing to give up? What sacrifices are you willing to make for your business? And so I think that like a reasonable founder salary, because it depends on how much resources you've stacked up as well. Can you actually do it, right? You have bills and obligations, things like that, right? So pay yourself enough to service your bills, and then find the investors that are going to be accepting of that. Some people are like, oh, you should only take a $3,000 a month salary or whatever, but then this is just one set of investors, right? If people aren't willing to work with you on that, whatever. So pay yourself what you need to be paid. Pay yourself what other people might be paying themselves in your sector at your stage.
I was curious about the differences between, say, the friends and family stage and the accredited investor angel section. It seems like there's a big gap between that. Like, there's a lot of restrictions on accredited investors. And maybe thoughts on, say, diversity and things like that.
Yeah. So the Securities Exchange Commission, because the Securities Exchange Act of 1939 says, okay, there's too many rubes, right? You can't just be selling your company to anybody. That's dangerous for everybody. So only people that make a certain amount of money can be considered competent, or people that have passed certain examinations can be considered competent investors. So it's a protection on the investor side, the legislation that creates angel investors as a class of investors or accredited investors, right? That's a federal consideration. States have their own considerations around this. So for friends and family, presumably your family's in the same state as you. If the investor and the family member are in the same state, there's looser regulations around that investment. Once we start talking about people in other states, that's when the Federal Securities Exchange Commission comes into it, and that's where that regulation is. But a common thing too is it's just like, what are the terms of that investment? So it's like, if you're giving away equity to your friends and family, typically they have your best interest at mind. Investors have their, oftentimes, financial interest in mind. So are they going to try to impose certain control on you? So these are different calculations kind of in that. And honestly, a good thing to do is, I'd say, find the money on paper first. So just like, who's going to invest in your company? Like, what's the minimum amount you really need to take to achieve like milestones to get revenue, like I was saying, because that's going to create different competitive incentives for investors. So really take the least you need from people that are going to try to take the least control over you, right? And that calculation is where I'd say the angel versus friends and family stuff is. So, one more question?
Yeah, thanks for the talk. I appreciate all the quantitative evidence that you provided. I wanted to hear your take on why do you think Seattle is not even top 3 on the podium in terms of fundraising, environments? Like, what's your take? What would have to be true for us to be top dog like the Bay?
Yeah, I think it's a culture, right? So we live in the shadow of people that made it big in the 90s, right? And then all the people that made their money off of those people making it big, right? And so those people have no incentive to take more risky investments. They're done, they're set, right? So there's not enough hungry people that are in this game, right? Or they're all camping on the Bay because our cousins made a whole lot of money for us. So they're like, oh, let them, consume all the risk, and then we'll come in at the Series A when there's less risk, right? And so some people said that it's like a feature, not a bug, that we're a net importer of venture capital, right? So it's like, okay, but I think in order to become like a top dog, we have to take more risk in earlier stages, right? And be a player. For example, like we're not raising a whole bunch of money on quantum computing, which is something that's fast coming at us. We're the number 2 AI hub, right? But it's like we're not present in like a lot of Y Combinator cohorts and things like that, right? So we have to get out there, shake it up, take more risks. A lot of people keep their day jobs for a long time. A lot of people, even though they have the wealth, their severance, don't go out and do it, right? But so the Bay, a lot of people are like, hands up, burn the boats, let's do it, buds, right? And so like that idea of this is how we're gonna spend our time, and come hell or high water, we're gonna do it, right? That is part of it. Another part of it is like the connectome of entrepreneur support organizations, legal services, all these sorts of things. In the Bay Area, a good statistic is that it's like every person that's on a board, there's like something like 30% likelihood that they're on 4 or more boards. So that's a big connectome, right? For us, it's something like 3% or 4% likelihood they're gonna be on 4 or more. And so just fewer connections among board members, fewer people being able to say, there's a surplus, there's a deficit, connect, so building that connectome. In Washington State, for example, we don't have a commission on startups. There's a nice nonprofit called Right to Start that's working for civic advocacy to get that in place. We have only like a position called Startup Advocate, I think, that is staffed every administration or so. So we don't have a persistent internal memory in a place that has as much wealth as we do through our hyperscaler tech firms that can actually steward the growth of this ecosystem. It's largely left up to the legal firms, the universities, and these other players, right? And they all have their own day jobs they have to worry about. So it's like there should be someone stewarding this, not from a controlling standpoint, but just someone that could present opportunities and especially allocate like participatory budgeting, right? A thing that I learned the other day, which was like, wow, so New Mexico has a sovereign wealth fund, right? They invest like it's $31 billion, right? So New Mexico, they invest in early stage venture capitalists who have the same thesis as more mature venture capitalists in their ecosystem, right? So you have people that can now do those deals knowing that there's a coherent capital stack, that if they do the deal in the thesis of the next guy up the chain, that deal, if they meet the milestones, can then raise that next round. So you have this less leaky pipeline. We don't have something like that here, right? So it's like building the ecosystem, building these procedures to repeatedly do this sort of stuff and taking on more risk. That's the only way we're really going to get up with the big dogs. So.
All right. Well, thank you so much, Evan, and everybody give a round of applause for a great talk today.
Thank you for having me.
Next Friday at noon, you'll hear from an investor, Allison Parker, who will talk about impact investing. Sign up today, and we'll see you all next week. Thanks again.